Welcome to another video. My name is Ian Phillips, and today I want to dive into the economic outlook of Orange County, as a lot of people are considering buying a home, but they want to make sure that where they're buying is going to have a strong economy. That is a hot topic in the United States right now. A lot of people are talking about job numbers, unemployment rising, and really we want to make sure that if you're going to be buying a home here, it's going to have a pretty good economic outlook. So in this video, I want to dive into the unemployment rate specifically in Orange County, compare that to California and neighboring counties like LA County and San Diego County, as typically when considering Southern California, a lot of people are looking in those three counties. I also want to look at the median home value in the overall country and compare that to the unemployment rate, because that is really the key driving factor for home values. If you have a strong economy, you have good job growth, and you have a low unemployment rate, that is a good environment for home values to increase in the short term and long term. But as we're going to take a look at later in the video, if you have the unemployment rate rising, typically home values are also declining, and that could lead to a recession. So straight away, I want to dive into the unemployment rate for Orange County. Right now, it is at 4.4%. That is below the country, the overall United States unemployment, which is around 4.6%. And we'll look at that a little later. But as you can see, it has had a steady rise, coming from a low of 2.7% in May of 2022 to now 4.4%. And it actually had a little dip in the recent numbers from 4.8 to 4.4. So overall, it is a pretty low unemployment rate. And as you can see, it definitely is nowhere near the financial crisis levels of 10%. And of course, we had the 2020 pandemic, and the overall country had massive unemployment issues. But 4.4 is still pretty low relative to historic standards. You can see even in the post.com bubble, it was at 5.3%, but went down pretty quickly after that. Now let's look at the unemployment rate in California as a whole, because when you're looking at counties, you want to see how the overall state is doing. And California as a whole is at 5.6%. Now, interestingly, it went down to 3.8% in 2022 and has been on a steady rise. And going back historically, California does get to pretty high unemployment levels. Post.com bubble went up to 7%, financial crisis went up to 12%, and as well in 2020 pandemic went up to 15%. But right now, Orange County is having a much lower unemployment compared to California, which is at 5.6%. So if we assume that if we were going to go into an economic slowdown, as of right now, Orange County has a much better job market and much lower unemployment by over 1% compared to California as a whole. Now, if we look at Los Angeles, which, by the way, has had a pretty bad housing market, home values have basically done nothing since 2022. We can see the unemployment rate in Los Angeles County is 5.9%. So higher than California and significantly higher than Orange County by roughly 1.5%. Pretty substantial for LA County. Potentially a reason why we're seeing the housing market much slower. Days on market is drastically higher than Orange County. So like I said, unemployment definitely a huge factor when it comes to what the housing market is going to do. And San Diego County, 4.9%, so 0.5% higher than Orange County as a whole. So it's kind of interesting that when you look at the overall counties, Orange County is significantly stronger than its neighbors. Now, I do want to briefly check on Riverside County because I forgot to pull this one up earlier. Riverside County. Riverside County unemployment is actually 6.1%, so even worse than LA County, San Diego County, and California as a whole. So definitely, actually, Riverside County is actually doing really bad. Has almost doubled since May of 2022. So now I want to go over how the housing market relates to unemployment. A lot of people like to point to mortgage rates, and while yes, that is absolutely a factor, the unemployment rate is actually more coincided to house values declining, at least historically. And when we talk about specific areas where you're thinking of buying a home, mortgage rates aren't going to necessarily impact a specific region. Mortgage rates are going to be a countrywide benefit if they decline and a countrywide impairment if they go up. So if mortgage rates are going to decline into the end of 2026, which I believe we will likely have a mortgage rate with a 5 in front of it. I just closed on a home first week of January and my buyer had a 5.89% mortgage rate. So we're already starting to see signs of that, but again, that is few and far between. So if mortgage rates are going to go down into all of 2026, that's going to benefit everywhere. It's going to benefit the entire country, the entire state of California, and all counties in California. So what is going to immediately impact the local area is going to be the economy, specifically the job market. It's just common sense. If you have a lot of people without a job, less companies hiring, the housing market in the area is likely going to decline. We see that in LA County. House values have done nothing for the last 3 years, while in Orange County, they have gone up year over year since 2022. That is sort of when the housing market in general started to slow down because mortgage rates went to 7%. But let's get into the overall country and kind of see the correlation between high unemployment, what home values do, as well as recessions. These gray lines are going to be the historic recessions. This is the financial crisis. This is the dot-com bubble here. Now I will zoom in a little bit so you can see a little more closely what the trend is. But as you can see, financial crisis, we started to see the unemployment rate increasing and home values dropped pretty drastically. We know that parts of the country had a 50% decline. Some areas it was buy one, get one free because home values literally were cut in half and the unemployment skyrocketed. Now, the dot-com bubble is different because the dot-com bubble, although it did see unemployment increasing, which is this blue line here, by the way, there was mostly a stock market issue because the NASDAQ dropped. I think it was like 85%, 90%, something like that. But the real estate market actually held up pretty well. House values were pretty flat during that recession. And we can see here unemployment rate increase in the 1990s. We had a brief recession and home values also dropped. And again, we had the inflation crisis from the 70s to the 80s. Every time the unemployment rate peaked, every time the unemployment rate increased, we saw a dip in home values. Again, here, unemployment rate goes up, house values dip. And again, in the 70s, unemployment rate goes up, house values have a pretty substantial correction. Now, I do want to zoom in a little bit. So what I'll do is look at 1970. This is starting in January. We can see a little better exactly how how the median home value declines and unemployment rate skyrockets. And right now we are starting to see stagnation in what the median home value is doing as the unemployment rate is increasing. So again, the unemployment rate has a pretty good correlation to sort of determine what the housing market is going to do. Yes, mortgage rates are absolutely a factor, but we've seen mortgage rates remain pretty steady between 6.5% and 7% for the last few years, and only parts of the country is experiencing a housing market correction. Places like Texas, parts of Florida, even parts of California, as I mentioned, LA, the housing market has been struggling for really the last 2.5, 3 years. But in parts of Texas, major cities, you're having 10, 15% corrections, and same in Florida. Why? Because the job market is negatively impacting the ability and the amount of people that are able to buy a home, coupled with mortgage rates being higher for longer. So when you're considering a place to buy a home, you want to make sure that the job market is going to be pretty strong in that area. There are, of course, a multitude of factors that impact where the median home value is going to go. Builders are another one. I'll do a completely separate video on that. Areas where you're seeing tons of new construction, home values are declining the most. Why? Because builders are desperate to sell. They're offering massive incentives, they're cutting prices, buyers are paying no closing costs, and as a result, you're seeing those existing homeowners trying to compete with all of those builders. And it's just not possible because builders work in volume. But I'll do a completely separate video on that. I want to dive into specific neighborhoods in Orange County where builders are negatively impacting home values. So stick around for that video at some point in the near future. But the correlation is pretty strong in my opinion. Home values decline, unemployment rate goes up. It puts a damper on home value growth in the future. And that is a 100% correlation. Again, multitude of factors impact growth, impact housing market, competitiveness, but a strong economy is a good sign that home values will appreciate in the future. Again, Orange County, 4.4%. Now, one of the reasons I think Orange County is substantially stronger in terms of economic growth and job hiring, lower unemployment rate compared to other counties. Again, we looked at LA County, San Diego County, and Riverside County, both of which have much higher unemployment numbers. San Diego County's not doing too bad, around 4.9%. But again, 4.4% is below the national average, historically a low unemployment. We're seeing tons of job openings in the healthcare sector. Orange County has a diverse range of what companies are hiring. Irvine has become a pretty big tech hub for a lot of companies. We're seeing startups, private equity moving their headquarters into Irvine. I have a few friends in the software engineering field, and they are constantly getting poached to be brought on to these startups that are paying pretty good salaries. The average salary in Orange County is substantially higher than a majority of the country. So it's no surprise why you have first-time home buyers being able to afford homes here. In 2025, I represented 3 or 4 first-time home buyers without help from their parents that were able to secure a single family home. Why? Because they had high-paying jobs. We had one of them working in healthcare, another working in the tech field, earning a very, very nice salary. All were jobs based in Orange County, had their headquarters here. I'm talking to people who are moving out of LA, being relocated from the Bay Area into Orange County because that is where a lot of people want to have their businesses. So that's kind of it for my economic outlook of Orange County. Looked at some of the data. In my opinion, if you're going to be buying a home, make sure the area that you are buying has strong job growth, has low unemployment. I do think there will be a recession at some point in the United States, but I think it's going to be very localized. And that is definitely something to pay attention to when you're considering buying a home for the next 5, 10, 15 years. You want to make sure that the area you're buying is going to have good growth, strong job numbers, low unemployment rate. That's kind of it. My name is Ian Phillips. I'm a realtor here in Orange County. If you're looking for an agent in the area, check out my website in the description below. You can contact me, browse for homes, get a free home valuation if you're interested in selling as well. And I'll see you in my next video. Subscribe for more.